Greetings, my name is Ted Hicks. I am the founder, CEO, and Chief Investment Officer for Hicks & Associates Wealth Management. Today is Wednesday, June 1st, 2022, and this is our monthly market monologue. This month we're going to keep it a little brief because next Wednesday, June 8th at 12 noon Eastern Time, we're going to be hosting a more in-depth economic update webinar. So we invite all to tune in at that time. Now, that said, registration is open to all, but you do need the hyperlink in order to join the GoToWebinar. So we do need you to register in advance for this event. But that's going to be next Wednesday, June 8th at 12 noon. I will certainly post the registration link in the comments section below. That said, let's dive in. So what's on the screen right now is the S&P 500. It is a monthly candle chart so that every candle on the screen represents a month's worth of trading. The far right candle, the one that looks like a cross, is the month of May. This is the month of May. So I have this color-coded to coincide with the reading of the vertical speed indicator. If you have been following us for any length of time, you know that the VSI is a composite indicator made up of 14 different individual components. So as you know, we use a lot of technical analysis in our asset management process, and there's no such thing as a perfect technical indicator that is going to definitively tell us anything. So we like to use what we call the weight of the evidence approach, and so we take 14 different individual components and we roll them up into one to come up with what we term the vertical speed indicator. So right now this is the VSI reading down here, so you can see that there was a correction at the beginning of, at the end of April rather, and then at the end of May we have improved. The VSI reading has definitely improved. However, when we take a look at that reading, we see that the short-term VSI components is saying 3 out of 7 buy signals, and the long-term VSI is only saying 1 out of 7 buy signals. Make a long story short, what that's really telling us is that the weight of the evidence still cautions us to proceed. However, this doesn't mean that we have been in cash all year long. So we'll talk about that in just a couple of minutes. What we really want to dial in on right now is take this same chart, and now this is a daily candle chart. So again, this is the S&P 500, and what I'm trying to show is that this candle right here is the beginning of May. And so for the entire month of May, again, the VSI was pointing us to a sell signal. Again, that doesn't mean that we were in cash the entire month, but what I'm trying to highlight is just the volatility of the month of May. So when we look at the monthly candle chart, it actually looks like it ended the month at about the same spot where it began. But when you actually look at what's called the wick, or the body, the wick of the candle, it looks like a pretty volatile month. I mean, that's what we're showing here on this next chart, where it was about 13% from the bottom of the month to the top of the month. So that is the S&P 500, the broadest measure that most people follow on a somewhat regular basis. What we want to dial in next is what we refer to as the participation level. As you know, again, the S&P 500 is comprised of approximately 500 stocks. I believe it's technically 505. It's comprised of 500 stocks, and but they are not all going to do the same thing. We talked a lot about last year how it is a cap-weighted index, so the biggest stocks in the S&P 500 have an oversized influence on what happens with the index. So we really need to peel back the onion layer, if you will, and really look underneath the hood to see what's going on. So what I have here is 3 different metrics on the screen. This first window is the percent of the S&P 500 that is trading above the 20-day moving average, or its individual 20-day moving average. And what we can see is that index, or that's showing us about 81%. In other words, 81% of the S&P 500 is now above its own 20-day moving average. When we look at the 50-day moving average, which in the stock market 50 days is approximately 2 months, we can see it has definitely improved, but we haven't quite reached that 50% threshold. And then on the 200-day, now remember the 200-day is what most people consider to be the long-term indicator. So 200 days is approximately 9 months in the stock market. So what I'm really trying to highlight here is, in order for us to have a lot of stocks above the 200-day moving average, you first have to see a high percentage of stocks above the 20, and then the 50, and then it's finally going to show up in the 200. And what we're seeing is some improvement here. So the fact that we now have 81% of the S&P 500 trading above the 20-day moving average, that's actually a very good sign. So let's talk briefly about the 3 major indices that the news media is most frequently going to comment on. That is the Dow Jones Industrial Average, which is negative 9.2% through the end of May. The S&P 500, negative arguably 13.9 through the end of May, and then the NASDAQ, which is negative about 23.7% through the end of May. Now, these are your 3 main indices that the news media is usually going to refer to in their reporting. This does not mean that your portfolio's return must be negative this year. When clients are looking at their portfolio performance for accounts that we're managing, most are pleasantly surprised. If you are not a client of ours and you're curious, by all means reach out. I'm more than happy to chat with you a little bit more about what we're doing and how we're doing it. But that's not the purpose of today's video, because I did promise to be brief. But yes, the broad markets are negative this year. That does not mean your portfolio has to be. So now let's talk a little bit about the various sectors of the S&P 500. And this is why your portfolio does not have to be negative year to date. This S&P 500 is divided into 11 different sectors. What you can see is the XLE is the energy sector. That is up about 55% year to date. Utilities is that sector. That's the Duke Energy, the Progress Energy, those types of Dominion Energy, that type of stocks. Those stocks are positive about 4.5% year to date. Again, that's the index, the utility index. But all of the other sectors are negative year to date. That's why the overall broad market is struggling, but that's also why your portfolio does not have to be negative year to date. There are pockets of where we can get return, and that's our job, is to go find those pockets. That's not a guarantee that we can always do it, but so far year to date we are pretty happy. Again, if you're not a client, we would be more than happy to talk to you about what we're doing and how we are doing it. So now let's talk for just a minute about the advanced decline line. This is something that we've been talking a lot about, and if you've been following us for a while, you might remember us discussing this last year. In particular, we were talking about some of the divergences in this indicator. So on the bottom of the screen is the S&P 500. Again, that's 500 stocks. At the top of the screen is the advanced decline line. Now, full disclosure, this is not the S&P 500 advanced decline line. I'm looking at the New York Stock Exchange advanced decline line. So these are all of the stocks that are traded on the New York Stock Exchange. And the way that we come up with this line is that we take the advancing stocks and we subtract the declining stocks. And what we are trying to highlight late last year, or mid last year actually, is that there was a topping structure. There's a slight negative bent to this trend line here, whereas the S&P 500 continued to move higher. And then later in the year and into the first part of this year, we saw the advanced decline line going down, whereas the S&P 500 was still in a slightly positive trend. These are what we refer to as divergences. Now, on the right side of the screen, you can see the advanced decline line is going down, as is the S&P 500. That's actually good news in my opinion, because now these indicators are in sync. They are confirming one another. And more importantly, you can see that recently the advanced decline line has broken through this negative trend. And so has the S&P 500. I would say this is good news. Now, we're going to pull up there for now, because I did promise to be brief in this monthly market monologue, because I really want to encourage you to join us next Wednesday, June 8, 2022 at 12 noon Eastern for our mid-year economic update webinar. Now, we are taking questions and answers there. You can submit your questions to me in advance if you would like. Registration is open to all. You do not need to be a client in order to join us. And matter of fact, if you are a client, we would highly encourage you to send the invitation out to a friend, a colleague, sibling, whoever. Many folks are wondering about this particular stock market year, and we would be more than happy to chat with others and let them know what we're doing, how we're doing, and we have the capacity to grow. The team is strong. We would be more than happy to chat with others to see if we can be of service to them. So that said, in the meantime, thank you for watching. I will look forward to seeing you next week on the webinar. Thanks so much.